Hey traders, welcome back to Forex Cracked. In today's video, we're going to break down a fundamental concept in Forex trading: support and resistance levels. If you're new to trading or looking to refine your strategy, these levels are essential tools you need to understand. So, let's dive into it. Let's start with the basics. In Forex, support refers to a price level where an asset tends to stop falling and bounce back up. Think of it like a floor that the price doesn't easily break below. On the flip side, resistance is a level where the price tends to stop rising and pull back down, like a ceiling that's hard to break through. These levels are crucial because they can help you predict future price movements and guide your entry and exit points. The market often respects these levels, making them powerful tools for any trader. To find support and resistance levels, look for areas on your charts where the price has reversed multiple times. If a price has dropped to a certain point and bounced back up multiple times, that's likely a support level. If it's tried to break through a price level but failed, that's resistance. Here's a simple tip. The more times the price touches a level without breaking it, the stronger that support or resistance is. So how can we use these levels in our trading? 1. Buy at support, sell at resistance. The most common strategy is to buy when the price hits a support level and sell when it approaches resistance. The idea is that the price is more likely to reverse from these points than break through them. 2. Breakout trading. Sometimes prices do break through these levels. If a support level is broken, it often becomes new resistance, and vice versa. This is called a breakout, and it can lead to significant price moves. Traders often look for breakouts as opportunities to ride big trends. 3. Stop-loss placement. You can also use support and resistance to set your stop-loss orders. For example, if you're buying near a support level, place your stop-loss just below it. If the price breaks through, the stop-loss will protect you from larger losses. Now, beware of false breakouts or fake-outs. This happens when the price breaks through a support or resistance level briefly, only to reverse back into the range. These can trick traders into taking positions too early. One way to avoid fake-outs is to wait for confirmation, such as a candlestick closing outside the support or resistance level, or look for increased volume to confirm the breakout is real. Support and resistance levels work even better when combined with other technical indicators like trend lines, moving averages, or oscillators like the RSI. For example, if a support level lines up with a trend line, it becomes an even stronger buy signal. Or if the RSI shows the market is oversold at a support level, that's a powerful indication the price might bounce. And that's a wrap on how to use support and resistance levels in Forex trading. These simple yet powerful concepts can help you become a more confident and successful trader. Remember, always combine them with other indicators and risk management strategies to maximize your chances of success. If you found this video helpful, give it a thumbs up and leave a comment below with any questions. Don't forget to subscribe to Forex Cracked for more trading tips, strategies, and updates. Until next time, happy trading!